Hi, I'm Keith McCullough. Welcome to our latest segment of Real Conversations. It's my pleasure and privilege to have Jim Lacamp, who's the Senior Vice President and Portfolio Manager at Macroportfolio Advisors at UBS to have a chat with me today. So, Jim, thanks a lot for taking the time.
Keith, it's always fun talking to you. It's always fun talking to somebody who can drill down a little deeper.
Yeah, that's what we're going to do here. I think it's a great forum and opportunity. There won't be any commercials, nothing like that, Jim, so we could kind of get right into the wood. When I turn on the television set, albeit half the time it's on mute, I could swear that people are saying that it's different this time, that bond yields falling is not a slow growth signal. Do you agree with that?
I think bond yields are falling for about four reasons. I think one reason you could point to is concerns about Russia and the Ukraine. You could point to that. Mm-hmm. You could point to short covering, and certainly there's a big short interest on the treasuries, and that was the big trade as we went into January. Buy stocks, sell treasuries. It hadn't worked out. Treasuries are up 9% on the year, so there has to be some short covering. But I really think a big part of it is that the bond market is signaling economic growth is not materializing like we thought it would. And then, Keith, when you look around the world, bond yields are down all over the world. And so if you're going to pay 5% on 30-year Greek paper, then we should be about 2.5%, and that's where we are. So I think it's saying slow global growth, slow U.S. growth.
Well, I mean, the manifestation of slow growth comes from a lot of different angles, so it doesn't surprise me that a pro like you would say, okay, look, there's multiple factors here. It's not a silver bullet. But like when you say, hey, look, the bond market is forecasting X on growth versus what I affectionately call old Wall Street forecasting Y, have you seen a divergence this wide? Pre-crisis, post-crisis, that's this obvious? The Street's looking for 3 to 4% GDP growth.
I can't remember this many divergences. I mean, when you see the bonds do what they do, it should have a bigger impact on the dollar. When you see commodities doing what they are doing, they should have a different impact on bonds. When you see what the major averages are doing, they shouldn't be holding up this well if the leading components of this market rally are getting shellacked like they are. So I'm seeing a tremendous amount of divergences, but I think that a big part of this is where people were positioned prior to these things happening.
Yep.
So you have a market that can really overreact because of the way they were positioned. In other words, big, heavy short position, and then you get a piece of economic softness that comes in, and the shorts all scramble, and so the bond market overreacts.
Well, it's amazing to watch that. I mean, if you look at it, just think, if you and I were talking at this time last year, everybody and their brother said that interest rates couldn't rip to the upside, and they did. That was the big kind of variant move in macro last year. And then you come into this year, and after the move, everybody thinks rates are going higher, and all they do is go straight down. So I don't think that this has done a lot for old Wall Street's forecasting credibility. But
I agree. And here's the other thing that's really interesting about this. The Federal Reserve Board has been tapering, and everybody would say, well, it's the biggest buyer of bonds. We should see those rates start to go up as they taper. But I think a different mindset is taking place. Fed's exiting the market, so maybe there's slower growth, and these yields come back down. And it makes me wonder, Keith, if they needed to be doing this at all to begin with, because here we are cutting this program, getting close to cutting it in half, and yields have gone down, not up. I wonder, again, with European paper trading where it is, with Japanese paper trading where it is, if we wouldn't be about where we were without all this bond buying program that we've had.
Now, you have bond market vigilantes, you have bond market riots, potentially a bond market going straight up, which is currently this year. You have a lot of different scenarios that a lot of people, at least a lot of smart people, didn't predict. And here we are no matter where you go. So what happens if growth surprises on the downside, inflation is much more impactful on real human beings than the Fed is articulating? Do you think by the June meeting that she could get scared and start to, again, rhetorically untaper?
I think that's a very distinct possibility, and at that moment, I think the Fed loses any credibility that they might have left, because it would signal that they don't have the control that they've been suggesting that they have. And it would also signal that their steps aren't working. And we already know that their steps aren't working. I got to tell you, and this is a little bit of a tangent, but when I see all these mergers and acquisitions, all this activity, which could be a record year, it makes me real nervous. First of all, this happened in 2000, right before we saw a 3-year sell-off in the market, and it happened in 2007. But it points out that Fed policy has made cheap, easy money available to the large, and it really hasn't impacted the small. So you have all these mergers and acquisitions because they don't have new customers coming in the front door. They don't have any incentive to build property, plant, equipment, or hire people. So what do you do if you're a business, if you have cheap and easy money and a high stock price but no new customers? You go buy somebody else's customers. And that's what's happening. So it's another example of how Fed policy has had really some, it's really been good for people like you and I in the business. It's been good for homeowners, but it really hasn't been good for the general economy in terms of spreading out to those that really need it most.
If you go back to like Henry Hazlitt or periods in U.S. Economic history that were born out of the same types of things, the 1970s, you call it stagflation or whatever you want, there's an American zeitgeist that develops, and then all of a sudden people have kind of had enough. Do you think that the current level of inflation, real-world inflation, relative to what the Fed is saying is in the system, is providing that kind of catalytic zeitgeist of angst that's getting people to move?
Not yet, but it's building. You're hearing more and more people talk about these things, and it's translating to retail sales. And not only that, but you're finally seeing some discussed with the federal government. I mean, the media shield that is put up around the federal government and fiscal policy is starting to get chipped away at almost every day, and they've done most of the damage themselves. But now the emperor finally seems to appear really to have no clothes, even though we've known this for a long time to begin with. So I think, yes, and there's a documentary that was out last year. We had the director on our show, Jim Bruce, called Money for Nothing. That was a documentary about the Fed and its failed policies, and it didn't draw any conclusions about what we should do moving forward, but I think the more these things get out there, and when you hit a price point on food prices, when you hit a price point on gasoline prices, it can really happen very quickly.
Or when you hit a collective price point. I mean, it's like kind of following, a game of three-card Monte at a point, because at some point you create the all-time high in corn prices and then they implode. At some point you create the all-time high in gold prices and it implodes. At this juncture we have the all-time high in U.S. rents. The all-time high in U.S. rents. That's, from what I can understand, that's a long time. That's a big number, Jim. Like if you look at people's mortgage payment.
To buy a home.
Exactly. So how do you read the, if you go side by side, even the BBC at this point, you can read the headlines where Carney, who's the Canadian that they brought in to deal with these British bureaucrats, he'll say, hey, look, home prices are prohibitive, for the mainstream population from both a rent equivalent perspective and in terms of home ownership. And at the same time in this country, you're running double-digit home price appreciation. Is there a voice for that, or is the lobby just too big where there's so many people that get paid on home price appreciation that people just don't want to talk about it?
Well, that's the way it's been, but I think we're getting very close to that tipping point. Even the headline in the Wall Street Journal, I think on Monday, was that they were going to try to start to re-loosen lending standards, but what they really need to do is get people jobs. Yeah, loosen them up more. They've been lending standards have been too tight, and they need to loosen them up. And you're right, it's not a re-loosening; it's a loosening to begin with, and that's why cash buyers have been stomping all over those that are trying to go out and get a loan and do the right thing. But so I think that happens. And I want to point out too that and people don't realize about this on a historical basis, but if you look at the Arab Spring, and if you look at all the uprisings you've had in the Arab world, you can overlay those with a chart on spiking food prices nearly every single time. And I'm not saying that would happen here. I'm saying that these tipping points happen very, very fast, and that we could get there very quickly in this country because, again, we're already seeing it start to show up in retail sales. The jobs market has been very, very sticky, and this is the kind of stew that creates this, and it happens very quickly.
Now, do you talk to anyone, and I mean anyone, that you respect? That, obviously it can be anyone in any walk of life that disagrees with that?
Sure. I mean, you're going to find some people out there that will point out that the economy has been growing for 5 years. Most of them are apologists or spin doctors and people that defend what the Fed is doing, and Ben Bernanke would defend. But even those that defend will admit things are not where we want them to be. It's the slowest recovery on record. It's the slowest jobs recovery on record, and now, as we're talking about, we're seeing increasing prices. And unfortunately, I think it's too complicated of a subject for most people to understand that Fed policy weighs into this and how exactly fiscal policy weighs into it. But yeah.
Well, that's part of the problem. I mean, you can, like anything, religions have been built on this. You can obfuscate pretty much anything through complication. So at the end of the day, isn't the question, is it so obvious that they're lying to me as an American through my cost of living that I'm just not going to listen to the obfuscation and the sophistication anymore?
Yeah, and I think it'll happen because what will happen is as retail sales continue to be soft or weak, and again, if these food prices keep going up and rent prices and gasoline prices, then retail sales are going to continue to be weak. And once that really starts to hit the bottom line of these businesses, and they start railing on their respective congressmen that they've been funding through political action committees and all these other things, it'll have an impact. People will lose elections, then it'll have an impact. But it may be another year or two. I think you're going to see some change out of this coming election. I think you're going to see a big change in the makeup of Congress, and that'll help address some of the fiscal policy issues. But in terms of the Fed, that's a tough one.
So you're saying you need to have a political change, or you're just going to get more of what you've had for a decade?
Well, I don't see how you're going to get jobs traction with the most complicated tax code in the world, with this uncertainty still over Obamacare, over pressure to raise minimum wage at a time when you've got a huge oversupply of unskilled workers to begin with. It's hard for me.
Well, that last one in particular is the answer. If you have a policy to inflate, and you're Bush and Obama, and you both had Bernanke effectively, or the second coming of Bernanke now with Yellen, and you have that policy to inflate, but you don't call it that, the only way to cover yourself is to raise wages and mandate it. That's also part of a socialist policy. So I don't doubt for 2 seconds that you go there. But again, I think if you throw too many things at including the kitchen sink at the argument, you start to lose people. And why don't we just make it really simple? Like the value of the dollar goes down, the cost of living goes up. This has been happening for 10 years, going on 12. And if you look at the secular chart that is U.S. consumption, it's making a series of lower highs and lower lows. You can see that it's heading on a road to perdition. So isn't that just the answer?
Yeah, that was the Grecian formula. I mean, that's we're moving down the same road to Damascus that they did. We're just doing it a little bit slower. But you can see what has happened, what the net result has been, and it goes well beyond 10 to 12 years. It goes all the way back to the formation of the Fed and what the value of the dollar has done since then. And then you compare the relative price stability of the dollar pre-Fed to post-Fed. It's not a very pretty picture.
If you have people that are looking for 3 to 4% GDP growth, if you really boil down their thesis, it's down to this resurgent CapEx cycle that you had in the mid-1990s. And I keep saying, newsflash, in the mid-1990s, the Federal Reserve went both ways. Greenspan raised rates by 50 basis points at a time and forced people to invest. We're in an environment where they force you, basically, I think what you said earlier is the Fed's forcing you to disinvest.
Yes, they are, and they've really neutered many components of our economy as well. If you look at what has happened to seniors under Fed policy.
Oh my God!
They're forced to live on unbelievably low fixed income rates or take risk in the stock market when they're at a stage in their life when they'd probably rather not take that risk. And what's going to happen when the stocks sell off? What's going to happen to this group that have been forced to take risks they didn't want to make or to take, and then all of a sudden the market's not providing the returns, and yet food prices are higher, and the COLA increases that they're getting from Social Security aren't keeping up at all with rents, gasoline, food. It's really been very, very difficult on them.
COLA is, for those of you who don't know, that's cost of living adjustments. It's a complete joke. It's basically a lie. One of your tweets, and by the way, if you don't follow Jim on Twitter, it's at Market Camper, right, Jim?
Yep.
On your Twitter handle. What I love about your tweets is that you use these great quotes, and one of your quotes on this front, hurting people with the truth is better than killing them with a lie. Now,
it's very appropriate in this environment, isn't it?
I mean, is it really a lie? Or are we being, are we being alarmist about this?
Look no further than the CPI. Is there anybody out there that would say that the CPI is running at the rate that their inflation rate is running at the rate that the government says they are?
1.3%.
Yeah, there is not a chance in Hades that people feel that way when they look at what they're spending money on. And
there's not a chance in Hades. I like that.
When you look at how they calculate the unemployment rate versus how they calculated it back in 1980, and if you take that misery index that you did in 1980 with Jimmy Carter as president, right before Reagan took over the presidency, that misery index was really high. Well, if they calculated these things, inflation and unemployment today, the way they did back then, it would be higher now than it was during the Jimmy Carter years.
What's interesting is that even the Keynesian economists are challenging the Keynesian economists. MIT's Billion Prices Project now calculates inflation at almost like a three-bagger versus what the U.S. government calculates at. So, with that number, 3.9% CPI, which I still think is relatively low, that's the MIT number, you'd be running negative 2% GDP right now.
Yeah, and that's why it's so hysterical when I see all these GDP estimates that we were going to get 4%. If we were going to get 4% real GDP at some point, you've got a lot to overcome with the reading we got in the first quarter. You're way behind there.
I think it's like mathematically impossible. I mean, the way that the government calculates in GDP, by the way, they have to adjust for this thing called the deflator. And the deflator last year, with commodity prices having hit a 2.5-year low, was basically the deflator was running close to a 40-year low. So, the deflator is going up, and newsflash, that's going to be subtracted from GDP. So, I would be shocked if we have 4% GDP growth, and it sounds like you're on the same page on that.
Yeah, it's like you pull up to somebody in a small town and you ask them how to get to the city hall, and they say, well, you just can't get there from here. That's the way we feel right now about.
Well, look. I mean, that's why I love to hear your comments. I mean, you just boil it down to reality, and that's what we're trying to do here. I'm certainly not aspiring to be a PhD economist at this point in my career. I don't think you are either.
Well, I would like to, let me just point out that Keynesians don't even know what Keynes said. He said to pay down debt in the good years, to pay it off. And then if you need to use it in the bad years to offset. Now, I don't agree with that to begin with, but even if I did agree with that, then you are looking at a government here that doesn't pay down debt in good years. We did briefly in the Clinton administration, but when we were doing well in all the other years, all we did was raise our debt. So even those that would defend Keynesian economics don't even understand Keynesian economics.
I think Bernanke makes Keynes look like a raging conservative. I mean, at the end of the day, I mean, Bernanke says now that you've established all these great successes in the economy, never mind pay down debt, why don't you lever that debt up multiple times and throw some pick toggle bond action on that thing?
Yeah, that's right.
I mean, he's basically telling you put leverage upon leverage. I mean, that's what he's trying to do, to replicate something above 0% interest rates.
And the Fed's balance sheet would have been wiped out several times already, based on how levered they are in any interest spike that we've had. If you would apply mark to market to the Fed's balance sheet, they'd be bankrupt. But they move it over to the Treasury.
That can't happen though. Ben today, again at the $200,000 breakfast or whatever it was, said that the Fed doesn't actually have to change the balance sheet, Jim. They can keep it dead pinned right where it is, and we're going to like it.
Well, yeah, the stock market has liked it, but I think the stock market is starting to suffer from some apostasy here, because the stock market is struggling now, and they don't know what to make out of the Fed.
You're going all Texas on me. I don't even know what apostasy means.
It means you're losing your religion.
Oh man, I love that. That's good. That's really good, apostasy. Now, we've had a fun discussion. I just want to give you a shot to end where we started, with a little question on music. So if you had to name the top song that represents the Federal Reserve in country music today, or yesterday, what would it be?
I'd have to go with Friends in Low Places.
Friends in Low Places by Garth Brooks.
Yeah, it's a classic, but it certainly applies.
Yeah, that is a beauty. From the hockey dressing rooms in northern Canada to where you're at in Texas, we would timestamp that song as a dandy. But thanks, Jim. I appreciate it. Thanks for
so
taking
much.
the time.
Really enjoyed it.
All right, take care. That was Jim Lacamp. This was a real conversation. If you have any questions for me, I'm at Keith McCullough, and you can find Jim at Market Camper on his Twitter handle.